Getting into a house these days is, well, it's tough. And people are coming up with all sorts of ideas to fix it. One of them is the 50-year mortgage. The idea is simple, right? Lower your monthly payment, make it easier to own a home. But is it actually a good deal? Or is it just a long-term debt trap? We're going to break down the numbers and find out. So yeah, that's the big question, isn't it? The entire sales pitch for stretching a loan over half a century is that you'll have more cash in your pocket every month. It sounds amazing, but we're going to dig in and see what you really get and, more importantly, what you're forced to give up to get it. All right, so let's set the stage here. We need some numbers to play with. We'll imagine a $500,000 loan for both scenarios. For a standard 30-year loan, we'll use a rate of about 5.99%. For the 50-year loan, the rate's a little higher, at 6.49%. And that's pretty normal, because banks see a longer loan as a bigger risk. So let's see how this plays out. Okay, first up, let's talk about the shiny object, the big appeal, the reason anyone would even think about signing up for a 50-year loan in the first place. It all comes down to that immediate hit of relief in your monthly budget. And boom, here it is. With a 50-year loan, your monthly payment is about $180 cheaper. I mean, that's not nothing. That's groceries, a car payment, you name it. On the surface, who wouldn't take that deal? It looks like a total win. And if you zoom out just a little over the first 5 years, that monthly saving really starts to look impressive. We're talking more than $10,000 that's in your pocket instead of the bank's. You can see why this is so tempting. Okay, but this is the part where you gotta pump the brakes and ask, what's the catch, right? That 10 grand doesn't just appear out of thin air. You know what they say, there's no such thing as a free lunch. So let's pull back the curtain and see what that extra cash is actually costing you. And that catch brings us to the, well, let's call it the dark side of the deal, the hidden costs. We're going to zero in on two of the most important things in any loan: how much interest you're paying and how much actual ownership or equity you're building in your home. All right, quick sidebar, because this is super important. Let's talk about principal. See, every payment you make is split in two. There's interest, that's just the bank's fee, and then there's principal. That's the part that actually pays down what you owe. And this is the key. Paying down principal is how you build wealth. It's how you actually start to own your house. So to keep this a totally fair fight, we're going to stick with that same 5-year time frame. This way we can really see apples to apples where your money is actually going in those first few critical years. And here's the first gut punch. Even though your monthly payment is lower with the 50-year loan, over those first 5 years you actually pay over $16,000 more in pure interest. So that lower payment is a bit of an illusion. A bigger chunk of it is just going straight into the bank's pocket. Okay, now for the main event. This is the part of the analysis that honestly is just jaw-dropping. This is where the true price of that lower monthly payment becomes impossible to ignore. It is all about the equity gap. And wow, just look at these numbers. This is the amount of your own house that you've paid off. After 5 years in the 30-year loan, you own almost $35,000 of your home. The 50-year loan, you're not even at 8 grand. You're just treading water. Seeing it as a chart like this just makes it so obvious, doesn't it? The equity you've built with the 30-year loan absolutely dwarfs the other one. Remember that $180 a month you were saving? Well, this is the trade-off. You've built over 4 times more wealth in your home in the exact same amount of time. So what's the actual damage? Let's put a hard number on it. In just 5 years, by choosing that 50-year loan, you are nearly $27,000 poorer in home equity. That is a massive difference in your net worth. So, when you lay all the cards on the table, the picture becomes crystal clear. This isn't really a good or bad choice. It's a trade-off, a really clear one. You know, the original analysis just nailed it with this one sentence. It lays the whole thing bare. Think about that for a second. You get about 10 grand in your pocket, but you give up nearly 27 grand in wealth. That is not a good trade. So let's just boil it all down to the absolute core trade-off right here. The gain? A little over $10,000 in cash flow savings over 5 years. The loss? Almost $27,000 in your personal net worth. And that leaves us with one last, really important question that you've got to ask yourself. For that feeling of a little less financial pressure today, how much of your future are you willing to sell off? Is that immediate relief really worth being so much poorer down the road? That's the real choice you're making here.